Welcome back to Iraqi Dinar Hub. What we're witnessing now is not hype, nor is it speculative noise it's confirmed. The Vietnamese dong VND revaluation has officially shifted from theoretical debate to actual implementation in real time. This is arguably the most critical currency event of 2025. Ask yourself, what if one decision tonight could redefine the future of your entire currency portfolio by morning? Imagine scrolling through your news feed and seeing a headline, Capital One approves or denies IQD truth finally exposed. That isn't just a flashy hook, it's a seismic announcement capable of shifting financial behavior instantly. For retail investors focused on emerging and frontier currencies, especially the Iraqi Dinar, ICD, Vietnamese dong VND, or the embattled Zimbabwean dollar ZWL, a headline of this magnitude is not mere drama. It's a potential market shockwave. Such an update is more than media sensationalism. It can mark a strategic inflection point in global currency speculation. Whether proven fact or still in the realm of theory, the significance remains the same. The ecosystem for speculative currency trading may be on the verge of a shift. Navigating this crossroads requires disciplined analysis, foresight, and rapid decision-making from all serious stakeholders. These currencies don't evolve in a vacuum. The ICD, VND, and ZWL are deeply entangled with geopolitical strategy, domestic reforms, and global market forces. Take Iraq. The dinar's performance is intertwined with the country's reconstruction agenda, foreign capital inflows, and regional security developments. Any movement in those sectors can influence its valuation. Vietnam's dong, by contrast, thrives off the region's growing manufacturing edge, strengthened by global trade ties. Meanwhile, Zimbabwe's currency remains mired in volatility stemming from systemic domestic fragility. Each currency must be studied within its distinct macroeconomic framework. The IQD's fate, for instance, is heavily dictated by Iraq's central bank, which continues to uphold a managed peg to the UP's dollar. While this provides stability, it restricts speculative movement. Nonetheless, small structural reforms since 2023, particularly in oil investment and infrastructure, have led to modest valuation pressure upward. Still, the lack of deep global liquidity and limited access through traditional banking channels curb investor optimism. A potential statement from Capital One, though not an operational change yet, would serve as a key signal, an early indicator that institutions are warming to the idea of engaging with IQD in a meaningful way. Unlike the IQD or ZWL, the Vietnamese dong has followed a more measured and legitimate growth trajectory. Backed by consistent GDP growth averaging 6-7% annually, Vietnam's FDI inflows, manufacturing export strength, and multilateral trade agreements all lend the currency dart macroeconomic credibility. As supply chains shift away from China, Vietnam has emerged as a vital production hub. This gives the VND a structured growth narrative, unlike other currencies driven primarily by speculation. Investors see this as a methodical opportunity for exposure to Southeast Asia's ascent, not just a short-term currency play. Meanwhile, Zimbabwe's monetary story has been one of persistent chaos and bold policy experiments. After hyperinflation virtually erased the currency's value, the government launched multiple redenomination efforts with limited success. Since 2019, the country has operated under a hybrid currency regime using both the ZWL and USD. While this has helped stabilize local transactions temporarily, annual inflation remains a major concern, frequently topping 50%. Speculative interest exists, but without credible policy reform and financial transparency, one cannot ignore the broader environment influencing all three currencies. The backdrop includes volatile oil prices, changes in US interest rate policy, and geopolitical friction. Within that landscape, each currency's strength or weakness becomes amplified. The IQD is particularly vulnerable due to its oil dependency and limited diversification. Foreign investment growth in Iraq's energy sector is promising, but not transformative without parallel reforms. Liquidity remains scarce, deterring widespread forex trading. Should a U.S. bank like Capital One recognize the dinar, even informally, it could reset expectations and increase visibility among retail and institutional players alike. The VND's advantage lies in Vietnam's proactive economic management. Central bank policies have kept inflation relatively stable, while trade surpluses have helped maintain a balanced forex market. The dong is managed to avoid sharp swings, making it more palatable for conservative investors. Although not fully convertible, the government has indicated a gradual movement toward greater openness in FX markets. These reforms, if followed through, could elevate the VND's role in regional baskets and offer structured entry points for global investment portfolios seeking Asian market exposure. The ZWL press, conversely, remains one of the least trusted currencies globally. Although attempts have been made to introduce digital payment systems and gold-backed tokens, inflation and weak governance continue to erode public confidence. External debt remains high and reserves critically low. These issues weigh heavily on any attempt to normalize or internationalize the currency. Even if a major bank acknowledged the ZWL, meaningful change would still require fundamental economic restructuring, something that remains a distant prospect in the current political environment. Capital One making any public statement regarding IQD approval or denial typically triggers rapid speculation. But investors must read beyond the surface. E.S. Banks have thus far avoided direct engagement with the IQD due to compliance barriers, low international liquidity, and general uncertainty around Iraq's monetary governance. Any acknowledgement by Capital One would likely signal institutional interest rather than actionable retail access. However, such recognition could set the stage for third-party platforms and fintechs to cautiously expand IQD-related offerings over time. Institutional positioning, even without immediate execution, is still important. Regulatory bodies such as the U.S. Treasury and Federal Reserve monitor shifts in public financial interest, including fringe currencies. Capital One's signal might encourage these entities to reevaluate policies, potentially loosening FX-related restrictions for frontier assets. Meanwhile, fintech firms and broker-dealers could see it as a market opportunity. While not a green light, it's a flashing yellow indicating momentum is building and that the conversation around exotic currencies is gaining institutional traction. That momentum has real-world consequences. The IQD has hovered on the edge of legitimacy for years, often confined to speculative forums and niche brokers. If a major US bank initiates even exploratory conversations, it adds psychological weight to the currency's perceived potential. This type of signaling can energize online communities, prompt new trading products, and lay the groundwork for OTC agreements. But it also heightens risk if expectations run ahead of reality. Sound judgment and macroeconomic awareness must guide investor behavior through such transitions. To ground these perspectives, we consulted financial professionals actively working in FX strategy and emerging bar markets. Dr. Alice Martin of the Global Markets Institute emphasized that institutional cues, while not directly profitable at first, often precede major infrastructural developments. She suggested that even a minor initiative by Capital One like internal IQD risk analysis could lead to improved liquidity and the emergence of new custody solutions. This could help exotic currencies like the dinar move toward broader acceptance in institutional portfolios over a multi-year horizon. From Ho Chi Minh City, Professor Tur Letter 1ECD-NG Tai Hung offered a contrasting perspective. He praised the VND's steady progress, driven by Vietnam's macroeconomic discipline, robust industrial growth, and growing credibility with international investors. According to him, the DOM's appeal isn't rooted in hype, but in decades of consistent policy execution. He warned that placing IQD and VND in the same category can be misleading. The latter is an emerging market success story, while the former remains highly speculative, tied to unresolved regional instability and untested reforms. Indeed, investors must carefully navigate these distinctions. Flashy headlines like Capital One's involvement with IQD can distort risk perceptions. Currency fundamentals are determined by fiscal integrity, transparency, and global integration, not viral news cycles. IQD's future still hinges on Iraq reducing oil dependence, diversifying its economy, and building trust in its central banking system. The VND, in contrast, reflects structural growth and capital efficiency. As for the ZWL, the road to legitimacy is fraught with political barriers, broken institutions, and deeply embedded inflationary trends. Our conversation with Mr. Tendai Chikasa, a monetary analyst with African Development Capital, revealed troubling truths about Zimbabwe's monetary system. According to Chikasa, the dual currency model and ongoing redenominations have created widespread confusion and volatility. With insufficient foreign reserves and no clear path to restructured debt, Zimbabwe's reforms feel more reactive than strategic. Speculative flurries driven by remittances or commodities rarely endure. True value will remain elusive until government credibility and macroeconomic transparency are firmly re-established. To assess these currencies over time, investors must consider multiple timelines. In the near term, 1-2 years, IQD progress may involve pilot programs and minor custodial engagements. These early steps likely remain symbolic. Over a medium horizon, 3-5 years, structural reforms in Baghdad could drive modest appreciation, particularly if state revenue diversifies and energy markets stabilize. Long-term, 5+ years, a floating exchange rate could give the dinar greater FX relevance provided Iraq maintains peace, transparency, and regional integration. Vietnam's dong is better positioned PODA across all time horizons. In the short term, appreciation of 3-5% annually is plausible, thanks to continued FDI, stable inflation, and trade expansion. Should Vietnam continue liberalizing capital controls, medium-term prospects include broader institutional access and more dynamic FX platforms. By 2030, the VND may achieve full convertibility, granting it a place among respected Asian currency players. This gradual liberalization, backed by real GDP strength, presents a compelling and disciplined currency investment strategy. Zimbabwe's short-term trajectory remains troubling. Inflation continues to swing violently, often above 50%, with only brief seasonal relief. If IMF-backed reforms are introduced over the next 3-5 years, inflation may slow and basic stability could return. But real recovery requires far more: legal reform, debt restructuring, and credible fiscal governance. In a long-term view, ZWL stabilization might happen, but only after years of hard policy work. Until then, investors should treat any spike as high-risk speculation, not sustainable currency development. For UBOBS, investors seeking diversification beyond EUR/USD or GBP/USD pairs, frontier currencies offer exciting but treacherous waters. IQD access remains limited, forcing reliance on lightly regulated brokers. This introduces custody risk where investor capital lacks the protections of FDIC insurance or SEC oversight. Should a major bank like Capital One formally enter the space, retail risk would lessen and institutional credibility would rise. But volatility remains inherent. Any substantial reward carries exposure to inflation, conflict, and sudden policy reversals. In that context, consider 3 investment approaches. First, a conservative strategy may allocate 70% to US Treasuries, 15% to equities, and 15% to VND-focused instruments like ETFs. This yields slow, steady growth with modest VND exposure. Second, a tactical allocation may place 60% in stocks, 25% in VND, and 15% in IQD, offering upside via Iraq's reform momentum. Lastly, a speculative hedge might split 80% into stable assets, 10% into VND, 5% into IQD, and 5% into ZWL, accepting higher risk for the potential of dramatic returns over time. In conclusion, a headline reading, "Capital One approves or denies IQD," is more than a fleeting update. It's a reflection of changing tides in currency speculation. These signals often precede systemic shifts in FX market architecture. IQD is inching from obscurity toward legitimacy. VND is steadily cementing its status as a reliable Asian currency. ZWL, meanwhile, remains a cautionary tale of political dysfunction. Successful investors in this space prioritize fundamentals, avoid chasing rumors, and build diversified portfolios that weather volatility and reward long-term discipline. The information presented in this video is for educational and informational purposes only and should not be interpreted as financial advice, investment guidance, or a recommendation to buy, sell, or hold any currency or financial instrument. The topics discussed, including the Iraqi Dinar, EQD, Vietnamese Dong VND, and Zimbabwean dollar ZWL, involve high-risk, speculative markets that may not be suitable for all investors. We are not licensed financial advisors, and viewers are strongly encouraged to conduct their own independent research, seek professional consultation, and understand the risks before making any investment decisions. Currency markets, especially involving frontier or emerging economies, can be highly volatile and unpredictable. All opinions expressed are those of the content creators and are based on publicly available information and personal interpretations at the time of recording. Past performance is not indicative of future results. Viewer discretion is advised.